Welcome back. Well, for the markets, stocks specifically, there's a lot going on and the markets have also picked up. So we have the Nifty, which is up around 135 odd points at this point in time. It's up around 0.6%. We have the mid-cap index, which is picked up to the high point of the day, along with the bank Nifty. So there's buying, which has come into financials, which is helping the entire texture of the market. Just want to point out that Apollo Hospitals continues to reign on the Nifty as the top gainer. So up around 6 odd percent for that particular counter. Hindalco is doing well. Remember, there was a positive CLSA note which came out. They have an outperform rating on Hindalco, so that stock continues to see some amount of gains. Just watch out for Alchem as well from the broader markets, where there are some brokerage reports or bullish brokerage reports which have come out on Alchem. So that stock doing well as well, up around 4 odd percent. Well, with that, it's a wrap on Halftime Report. Thanks very much for watching. Business Lunch up next.
Well, we spoke with the management of Gateway Distriparks Parks just a couple of weeks ago on their numbers, but incrementally, the company has gone ahead and signed an exclusive container train operations agreement for a multimodal logistics park in Ankleshwar. And this will, entail the company providing them rail services for that logistics park. So let's get in Samvid Gupta once again. Samvid, good to speak to you, so soon once again. The quick questions that we have for you. If you could give us an incremental volume and revenue potential for this, and what is the kind of EBITDA per TEU that you would expect in a business like this?
Hi, good afternoon. So there are two aspects to this agreement that we've signed. One is the domestic side, and then there's the EXIM and DPD business. So for domestic, we can start immediately, and we're expecting about 1,000 to 1,500 TEUs as the exit number for the year per month. But there's good potential, and we can take this up to 3,000-4,000 TEUs per month over the next couple of years. The EXIM part, they've received the in-principle permission, but fully the operations for the ICD portion will start probably by April next year. And there's good scope here. There's only one other ICD which is full right now, and a lot of it is going by road. So we hope to convert a lot by from road to rail, and it's 100% towards JNPT right now. And this can probably scale up to 5,000 TEUs per month over the next, again, 2 to 3 years of operations coming in. With the potential of going up to 10,000 TEUs per month. The revenue side and EBITDA side, we have to see, because the lead distance is much shorter compared to our normal mix right now, which is primarily 90% for the north. So the EBITDA per TEU we're looking here will be about 3,000 rupees per TEU.
Okay, all right. So that's the EBITDA per TEU that you're looking at around 3,000 odd rupees. Samit, just wanted to understand, what is the investment by the company in this particular project?
So this is a complete asset-light model for us. What we've signed is zero investment from our side, as the trains are on lease, and even the containers that we will use for domestic purpose, those are also available on lease. If there is regular good volume on the domestic side, we will invest in the container side, but that will be very nominal. So for us, it's a EBITDA sharing basis that we've signed this agreement.
Okay, Samvid, thank you so much for joining in this afternoon and giving us a quick check in terms of, what to expect from this new update that has come in from the company as well. So that's the management of Gateway Distriparks Parks for you all in terms of the latest update. But on that note, we're going to actually slip into a very short break, and we'll get you more on the markets and stock-specific action on the other side.
Welcome back, and joining us on the show is Atul Chaturvedi. He is Executive Chairman at Sri Renuka Sugars. Mr. Chaturvedi, hi, thank you so much for joining in. First of all, on sugar itself, how would you look at the markets? Because everybody seems to be talking about the festivities right now. How has the sugar consumption been? And would you say that sugar availability is clearly not a concern right now?
No, sugar availability is definitely not a concern, because we have adequate stocks, and in any case, India has been consuming much less sugar compared to last year. So my take is that marginal increase in the sugar prices is definitely on the cards, and largely on the strength of even lower allocation which the government has given for the month of August. August month, they have only allocated about 22.5 lakh tons. So this is actually helping sugar values go up marginally. But I don't see sugar prices running away, because what we are seeing is that the next year's crop looks to be much better than what it was last year. And in any case, the crushing also would probably start a little earlier. And maybe Diwali is earlier, so you could possibly see crushing taking place from to a third or fourth week of October. So that should keep a lid on the prices.
Sure. Mr. Chaturvedi, also, there seems to be a lot of numbers floating around for India's annual sugar consumption, anywhere between perhaps 279 to a 285 on the higher side. What is your take within this?
No, I was doing a little bit of a sum as far as the allocations for the current year goes. So allocations till August are lower by about 1.4 million tons compared to last year. So even assuming last year about 700 to 800,000 tons of material would have slipped into Bangladesh, because Indian situation with Bangladesh was much better. So you would probably see the drop in allocation, effective drop in allocation by about 700 to 800,000 tons. So my take is that our sugar consumption is not above 28 million tons. And we used to earlier pencil in about 500,000 tons of increase on an annualized basis. Now we would probably be penciling in just about the growth in our population, which is closer to about 1%. And at 1%, it will be roughly about 250,000 tons on an annualized basis. The sugar consumption is definitely on the decline. It's not, and the whole lot of alternates, and you also keep talking about 17 alternates. So that is also bringing down the consumption probably.
Chaturvedi, would you say that it is the household consumption which is declining, but it really is the Horeca or the bulk consuming or the institutional buying for sugar, which clearly seems to be growing, with the fact that you have processed food and bakery items and ready-to-eat food doing quite well?
No. In fact, contrary to what you're saying, what we've seen is on the beverage industry has been struggling for sales. In fact, India hardly had any summer worth the name. We probably didn't see the full impact of summer this year. And the beverage consumption has been down, and beverage is one of the biggest consumer of sugar. You look at cola or you look at Pepsi and things like that. So probably that segment is facing demand headwinds. Other segments like Horeca and all, their increase may be marginal, but I don't, and that will get factored in within that 1% growth. But beverage is one of the major commodities which has suffered this year.
All right. How are you also looking at the prices then? Because while, of course, the industry has been asking for an increase in that minimum selling price, it also is about the cost of production and the retail, where we haven't seen too much of a gain. But as you said, some bit of an incremental gain is what the street can anticipate during this festival season. What do you see that as a percentage of?
I wouldn't say the industry has been demanding the raising of the minimum selling price, because sugar being a very highly regulated industry has been talking in terms of taking the price increase to about 41 rupees or closer to that, and with the FRP also going up in the current season or the forthcoming season. So there's all the more reason why it should be taken up. But having said that, more important, but the reason why we are insisting on this is it should get actually institutionalized. As it is, that 31 rupees price which has been fixed by the government is meaningless, because sugar is selling at much higher prices for that. But what is more important than the minimum selling price is the ethanol. And ethanol, we are now hearing a whole lot of funny stories, or whether they are targeted stories, we don't know. But ethanol is where we actually need price increase if India is to continue to keep 20% blending as their target.
At that point, thank you so much for joining in and giving us those details. Mr. Chaturvedi, ethanol is where price hikes are needed. This summer was impacted by low sugar sales because of beverages and, increasing trend of people going off sugar as well. I was looking at a Varun Beverages note, which is obviously the bottler for Pepsi in India. They say that 59% of their consolidated sales volume, so the last 2 quarters, between 50 to 60% of their consolidated sales volumes have been from products which are no or low sugar. So obviously that does not bode well for the sugar industry, even as it does for everyone's health. So we'll watch out for how that pans out. Thank you, Manisha, for taking us through with that conversation. Take a short break. On the other side, we have the management of Gateway Distriparks joining in about their new agreement on a multimodal logistics park. The market picks up once again, closer to 25,600 on the frontline index. In a regulatory boost for Paytm, the RBI has granted an in-principle authorization to operate as an online payment aggregator to the company. Ritu joins in with more updates because, the street is cheering that move. Remember when it was earlier taken out, the stock was down big time. Now it's recovering all those losses. Ritu, good news coming in for Paytm.
Well, after a near 3-year wait, the Reserve Bank of India has finally granted Paytm's 100% owned subsidiary, Paytm Payment Services Limited, in principle authorization to operate as an online payment aggregator. Now, that is essentially the business which runs Paytm's digital payment gateway for all of its merchants. But importantly, RBI has also lifted the ban on new online merchant onboarding, which had been in place since November of 2022. But to be clear, even when that ban was in place, Paytm had still been servicing the existing online clients and it had also been signing up new offline merchants. But this, of course, clears a big regulatory cloud over the payment business. Now, the market is quite crowded. There are more than 50 players that have this license, but Paytm's massive base of 1.3 crore merchants does give it a strong shot at regaining momentum. The timing is also quite interesting. It comes just days after its Chinese investor Antfin fully exited Paytm, selling that remaining 5.8% stake. Now, remember, Paytm's initial application in 2022 was returned by RBI, and the company had reapplied for this license only in September last year after getting the government's nod for its downstream investment into PPSL. Keep in mind, though, that the RBI nod right now is not unconditional. The company will have to complete a system and cybersecurity audit within 6 months' time and submit the report to RBI or risk losing the license. Now, brokerages have given the move a thumbs up. Citi says the license win is positive for sentiments because it lifts a major regulatory restriction on the business and it will help Paytm be more competitive than before. And Bernstein adds that this will have limited immediate impact on metrics, but it is a major relief nonetheless and is going to support higher payment margins for the company over time.
Okay, all right, Ritu. Thanks very much for that. Just keep your eye out on Max Healthcare. That hospital company has come out with its numbers and the stock should come up for you. It was reacting positively to the Q1 performance. So on your screen for Max, as you can see in the green for that particular counter. Vivek now joins in, however, to take us through all the stocks that are moving around in trade this morning. Vivek, over to you.
Well, thank you so much for that. So many results, so much news flow, so a lot of stocks to pick in today's trading session. Well, first on the list, in the list of gainers, you have to start off with Apollo Hospitals. A strong beat across all parameters. That particular stock high by almost 6% in the session today. One of the top gainers, even in the F&O pack. The other stock on the radar, one that we haven't discussed much since morning, is Archean Chem. One of the subsidiaries of the company has received the government nod to set up a semicon fab unit. The back of that stock high by 8% was up almost 12% at one point during the session. The other is a list of defense companies. So Bharat Dynamics, despite a loss on the bottom line, as well as operationally strong performance, all of the defense companies in this particular quarter doing quite well. HAL, BML, all of these stocks among the top gainers today. Honasa or Mamaearth, as already known, that particular stock, very good set of numbers. Margin expansion on the cards. Company has given a very strong guidance as well. That stock higher by 7% today. But again, on the list of laggards, quite a few. NSDL, remember, post-listing, very strong listing, post which the company did see significant up move on the back of a slightly muted Q1, seeing significant profit booking come about in the session today. The other stock, EMS Limited, this particular infra player, slightly muted set of numbers. Operating leverage didn't really play out as expected. That stock down almost 4%. Rupa and Company, again, this particular stock from the broad end of the markets, a weak set of numbers, almost 9% lower. And Oil India, remember this particular stock in the F&O space, one of the top laggards today, profitability dipped over 50%. And on the back of that, that stock lower by almost 5% in the session today.
Okay, Vivek, thank you so much for that. So those are the buzzing stocks. And as of now, the Nifty is inching back towards those days' highest point, 24,600 around that mark. But what is the F&O setup looking like this afternoon? We have Mangalam to give us those details.
Yes, the market has indeed moved higher right now. The Nifty is above the 24,600 mark, and that's an important level to watch out for from a market standpoint as well. Let's keep an eye out on the mid-cap index along with the Nifty Bank. What's taking the Nifty higher right now is the underperformance of the Nifty Bank, which was marginally in the red, is now turning into an up move. And let's see whether that continues. If that moves into the outperformance thing, we'll have to watch out for how that goes. The India VIX is declining, and that's a good sign. With the market moving higher, the India VIX going down by about 0.5% is good news. And we have a lot of these sectoral indices supporting the frontline index as well. So we have the metals index doing well, the auto index doing well, along with the Nifty pharmaceutical index. We'll have to watch out for whether the IT index at some point picks pace as well or not. The broader markets, the advanced decline ratio, the lines briefly came closer, but now they're moving far apart once again, with 1,500 stocks in the green for about 1,100 stocks, which are in the red. So for the Nifty, two levels to watch out for. On the way up, we have the 24,531 mark, rather on the way down, that will be the support. The Nifty has actually conquered the 100-day moving average in today's trading session. But yesterday's high of 24,703 is important for further short covering in the market. And there are a lot of shorts in the system. FIs are 92% short in index futures. For the Nifty Bank, the important support area is the 100-day moving average, which is around that 55,000 mark. Now we are seeing a bit of an up move from there itself. The 24,600 mark is the fulcrum, where we are seeing both put and call writers active. So 24,600 put writers, premium of 50 rupees, telling you 24,550 thereabouts would be support coming in. But at the same time, the 24,600 call writers have a premium of 85 rupees, telling you closer to 24,700 or yesterday's high. There would be some supply coming in for the frontline index as well. So we'll watch out for these two levels, but much lower around the 24,425, 475 mark. There is a much stronger support. A lot of stocks on our radar. Nykaa, the stock moved to the high point of trade post the management joined us, saying there could be higher growth prospects for the company in the next couple of quarters. A lot of long positions added on that. Apollo Hospitals, Ekta has been telling us good numbers coming in. The management joined us as well. That stock too at the high point, seeing a lot of long positions being added, along with the second day running well bid up stock was Alchem Labs. So for two straight sessions, a lot of long positions on that counter. Finally, we have Suzlon, which is seeing a lot of short positions being added. So watch out for that stock.
Okay, all right, Mangalam, thanks very much for that. So that's on the F&O space. We'll take a short break. On the other side, Manisha Gupta will join in to discuss what she's talking about in the commodity space. She has Atul Chaturvedi of Sri Renuka Sugars joining in.
Welcome back to Halftime Report on CNBC-TV18. Let's put the spotlight on Nazara Technologies, a mixed set of numbers that came in Q1 FY26. New acquisitions like a Curve, which was acquired last year, one full year over there, that's managed to do good growth. Smashes, that's come in as well in the offline side of the business. Gaming business has done well, but the bit of a subdued performance that came in from Sportskeeda, Pokerbazi, muted set there. So what is the outlook of the company going forward? What are we watching out for in terms of overall the growth from the offline business as well? We have Nitish Mittersen, who's the joint MD and CEO of the company, to talk to us about the numbers. Nitish, good afternoon and thank you so much for giving us your time. Let's start by talking about your overall growth story that's coming for the gaming side of the revenue business. Good growth, whether you look at it sequentially or year-on-year basis. Now, how have the sub-segments done in this side of the business, as well as in terms of contribution that you've seen coming in from the newer acquisitions? That's Curve as well as Smash. How is that performing as well?
Sure. Our gaming business, year-on-year has grown close to 160% in revenues and contributed over 300% year-on-year growth in EBITDA. I think our strategy of building, core gaming, established IP-first businesses is paying off very well for us, and we will continue to do that. We've acquired new businesses in Curve Games, which is the first entry into the PC and console space, and a few sports games, which makes the Love Island game, is now launched. Big Brother, we're launching Big Boss very soon. So I think we've got a series of very well-known IP coming out, and we're very excited about this gaming segment, high EBITDA margins as well.
Okay. Nitish, hi. Welcome to the show. Just wanted to understand what's taking place with Kiddopia. It's seen 9 consecutive quarters of a decline in subscribers.
Yes, I think we've been working a lot on it, but it's obviously taken much longer to recover than we originally anticipated. That said, if you look at this quarter's results, overall KPIs seem quite good. Our cost of acquisition has reduced. Most of the KPIs you look at, like churn, etc., have improved. So I think we're getting there. Hopefully, the light at the end of the tunnel is there, and we should start showing some growth in the coming quarters.
What about, esports? That saw 29% decline quarter on quarter. Nodwin as well, continue to report EBITDA losses. What's the turnaround plan for that? And what really was the rationale behind, you de-subsidizing Nodwin?
Sure. I'll speak about Nodwin first. As you know, Nodwin has been the market leader in esports, and they actually continue to grow quite a lot on revenues. Year-on-year growth is 49% for this quarter, and I think this whole year revenue growth is going to be quite significant. The Q1 saw slightly exaggerated EBITDA loss of 11 crores, but I think they will catch up in the rest of the year. And we're quite confident that this company this year or latest by next year will be profitable. So I think maintaining market leadership for Nodwin is important. And in that context, they will have to raise more capital and aggressively grow the business. Now, from a Nazara perspective, as you can see, our gaming segment is, our core gaming segment is generating high margins for us, very healthy cash flows. And we have a lot of attractive opportunities to invest in that business, both organically as well as potentially new studio acquisitions. So we kind of took a call that at this stage, for us to invest more capital in Nodwin versus investing into our core gaming business, that was a capital allocation priority that we have done. And this also, the deconsolidation allows Nodwin now to go out and raise funds from external investors, which can potentially aid a lot of their growth. It's important to remember that we own a large stake even post deconsolidation. We'll probably land 46-47% ownership. We are the largest shareholder, and therefore, Nodwin growing aggressively and building a lot of value for us will be very useful for us in the longer period. As far as Sportskeeda is concerned, this quarter has definitely been a disappointment for us. That's a company that's been on a fast growth track in the last 4 years and been highly profitable for us. Unfortunately, due to some external changes at the Google end, the March Google update kind of destabilized the sportskeeda.com traffic, while their other properties continue to do quite well. So we're taken a couple of, we've reduced costs, we've reduced content costs, we've right-sized the teams, and hopeful that this will recover in the next quarter or two.
So you're expecting recovery in the next quarter or two for Sportskeeda. Just two questions that are from my side. One is in Kiddopia, the margins. This time you said that there is some royalty cost that comes in as well. So now this is what you'll be paying every quarter. Is it yearly? When do we expect this impact to actually, come in every year? As well as in terms of ad tech business as well, what is the outlook there? Because sequentially we are seeing a decline there. So when will you start seeing those synergies come in for data work, space and time acquisition that has come in as well?
Sure. So on Kiddopia, we have partnered with global IPs. Such as, with Mattel, we have a partnership for Barbie, and we have some stuff happening with Hasbro, etc. So these are revenue shares we pay on a monthly or quarterly basis. Initially, you're seeing a slight, decline in EBITDA margins, but over a period of time, the IPs will actually drive a lot of organic traffic, so our cost of acquisition should come down, and the margin should go back to where they were. In terms of the ad tech business, we are starting to see good synergies play out between space and time and data works, the cost side as well as on the product and revenue side. So again, I'm sure this year we will see, those margins come up and those synergies kind of play out.
Okay. Nitish, just quickly before we let you go, what is the plan in terms of scaling up the offline business? How much is it going to probably be a percentage in terms of total sales going forward, and how important a segment is it going to be?
I think it's a very exciting space for us. We have 2 assets or 2 IPs over there. One is Funky Monkeys, which is for younger kids. Funky Monkeys had about 10 centers when we acquired it. They are up to 14 or 15 now. And now the launch rate has increased a lot. We're launching at least a center a month and hoping that over the next 2-3 years, we should be able to take this to 75 to 100 centers. I think there's a huge potential in our country for this kind of format. And, even 500 centers could be, hosted in our country. So I think profitable business, quick break even, and we are pushing very hard on that. Smash for us is a great IP that we've acquired. It requires a little bit of stabilization and reinvention. So you will start seeing growth over there in FY27. But there's a lot of synergies that we see that we can bring from the online Nazara, what we do, into these offline activities. And we also believe that, consumers increasingly, especially the youth, want to go out for social, interactive entertainment experiences. And the share of wallet will keep increasing over there. So I think it's a great space for us to operate in.
Wonderful. People do want to go, Nitesh. It will be very interesting to see how much they can afford it right now. And secondly, how profitable as a proposition it is for you versus esports businesses or, online gaming where the margins are obviously a lot higher. But that conversation for another time. Thank you so much for joining in. With that, we'll slip into a short break. As we do that, let's give you a reminder once again. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interactions with our journalists along curated studio tours, e-learning sessions and masterclasses along with lifestyle benefits.
Stocks notch small gains even as geopolitical and trade uncertainties persist. Metals and healthcare gains even as FMCG and IT drag.
Apollo Hospital turns in a strong show with all three verticals growing in double digits. The addition of 500 beds in the second half of the year is expected to further push growth in FY26. The healthcare major is also keenly scouting for acquisitions.
Hindalco MD Satish Pai holds out a firm forecast for aluminum and copper demand that should help it sustain profitability through FY26. He also expects cost savings to boost Novelis' performance in the second half. The stock perks up.
RBI grants Paytm Payment Services the nod to operate as an online payment aggregator, pulling back on merchant onboarding restrictions imposed in November 2022. The easing opens up the channel for growth, sparking a rally in the stock.
Nykaa owner FSN E-commerce turns in a good show with strong growth accompanied by margin expansion, though fashion sales remain a drag. Honasa Consumer too beats expectations with healthy growth in volumes despite early monsoon hurting the sunscreen sales.
Good afternoon. You're watching us here on Halftime Report. I'm Bangla Malu. With me, Ekta Batra and Vinny Motiwala. We come to you live from the CNBC TV18 Motilal Oswal studio. It's looking better for the markets than it was yesterday. Yes, we moved to higher levels yesterday, but there was a lot of volatility through the course of yesterday's trading session as well. Today, we're not as high as we were yesterday at close to around 24,700, which was yesterday's high on the Nifty. We're holding with gains, but it's the Nifty Bank, which is, slight underperformer. We're managing to hold on with the advanced decline as well, doing better than what it was yesterday. So all said and done, we're better than what it was yesterday. Just mild green is what we're seeing.
Hi guys, yes, absolutely. It's consolidation, you'd have to say, and that seems to be the big theme that is playing out for our markets in the past couple of weeks. We're just about treading water, considering that we have a lot of uncertainties to deal with. What will be the eventual tariff that India will have to reckon with? And not to mention that in the more near term, we do have the US-Russia meeting, which is taking place on the 15th of August. So, and that I think would be very important as a trigger to watch out for. But in the near term, at least, it is the inflation data from the US as well as India, which has boded well in terms of sentiment for the markets. For the India CPI, that has come in at an 8-year low. So definitely possibly opening the room in the future for possible rate cuts. But nonetheless, for the Nifty, just about consolidating with a gain of around 0.3%.
Absolutely. Hi, guys. Good afternoon. So in terms of individual sectors, let's look at that. We have Nifty Metal that's managing to hold on to some bit of a gain today, 1% gain coming in there. Pharma, again, some of the names over there are doing well. So Apollo Hospital numbers that came in. Alchem, also good numbers that we're seeing in terms of a good traction for the stock as well in today's trading session. So Pharma today is buzzing in trade. Other than that, a lot of names on the back of their earnings, whether you look at Nykaa, that's FSN, e-commerce, Hunasa Consumers, among some of the names that are buzzing in trade. But like we're talking about Nykaa, good strong show that came in from the company. Margin expansion is also what we saw in Q1 FY26. Now, Mangalam caught up with Adwaita Nair, the co-founder at Nykaa and executive director and CEO at Nykaa Fashions and head of owned brands to discuss the quarter gone by, and began by asking about the growth in the beauty and fashion segment and what's the outlook going forward there. Listen into that conversation.
We're feeling really good about this quarter for two big reasons. One is the fashion growth is back. After about 5-6 quarters of sort of a challenging environment for fashion, and I think fashion generally remains quite competitive and challenging in the market. But Nykaa Fashion has emerged really well. In Q1, the fashion business has delivered 25% growth, which is a significant improvement from the last couple of quarters, and also significantly higher than what the market is seeing, and also a very significant loss reduction with EBITDA loss coming down by 300 bips. So I think that's one big theme that we're excited about, that fashion is on track, and we're really confident that that thesis will play out. And the second is that this house of brands business that you sort of alluded to, which is where we're building our own brands, has also had a very, very strong quarter with over 70% growth. And now that one business where we make our own brands is tracking towards a 2,700 crore top line, and again, very profitable, compared to the rest of the business as well. So it's a great shift that the business is undertaking from retailer to also being a house of brands.
All right, the first quarter was good. You think that the next couple of quarters are likely to be fairly strong as well, continue the momentum. If you could give us a sense on, what kind of GMV growth can we expect in both the beauty and the fashion business over the next couple of quarters? The second half typically better for the fashion business as we move towards festive season.
Yeah, I think, beauty has been very consistent at this sort of mid-20s for the last, 6 quarters or so, and we'll hope to kind of stay steady with that. We're slightly outpacing the market growth there, and, every quarter sort of chipping away at a little bit more market share. I think fashion is where we should see an acceleration. We are feeling really confident with where the business stands today. I think Q1 at about 25% is sort of the start. I'm hoping, and we're sort of looking forward to collectively for a higher growth rate going into Q2, Q3. That is season for us, and we also have some really strong launches and partnerships that should come through to drive much of that.
Would that mean, better EBITDA margins as well? Because in your investor day, you had guided for break-even on the fashion business, at least by the end of this year. You're on track for that?
As of now, if the growth momentum continues the way it is and the way we're seeing it, even going into the next couple of quarters, there is definite intent to get to that EBITDA break-even number. If you just look at the track record, year-on-year, fashion has improved the EBITDA margin from a -9% to a -6%. And even if you just look from last quarter to this quarter, there's again 100 bips improvement. So I think the fashion team does have a track record of continuously improving the cost profile. So I think as long as both these trends sort of continue, it should be on track.
Give me a sense on Nykaa now, because you guys had plans for that. I mean, what have the initial, numbers on Nykaa now been? What's the investment been like? How much incremental growth have you seen in areas where there is Nykaa now?
So we launched our Nykaa Now, which is our sort of our quick commerce proposition, a couple of quarters ago, and we've been slowly kind of steadily building on it. It's now available in 7 cities with 50 dark stores. We've serviced about 1.3 million orders till date. I think what was really important to us as a team was not just rushing into quick commerce in that form, but more finding a value proposition and a customer proposition that made sense. So when people opened up the Nykaa Now section of the app, what really was the proposition? And for us, we honed in on the widest delivery of beauty products in that, that need quick commerce in the shortest amount of time. So we've spent a lot of time figuring out what the merchandising strategy should be there. And therefore, I think we're really hoping that the merchandising strategy creates a lot of product market fit, and then we scale further from there.
So what's the expected scale up of Nykaa now from here on? And could you give us a sense on the investments that it'll entail, and could there be an eat into the beauty business margin because of this?
So right now we see sort of a measured kind of foray into further expanding. We feel that this is a top city strategy, and we're going to focus on attacking the top 10 cities. We are not trying to go after the 15-minute delivery. We do state strongly to our customers that this is a 30-minute to a 3-hour delivery time frame, and we think that the customer is totally fine with that. So it is going to be more of a measured play for us.
What kind of margin guidance can you give us for the beauty business for this year, even as GMVs grow at mid-20s?
I think, it's a story of different parts. So you've got the e-commerce business, which has even higher EBITDA margins. You've got the superstore business, which is currently loss-making, though again, in our earnings, we did describe that the losses there are coming down quite rapidly. And then you've got the House of Brands business in there, which is even higher EBITDA margins. So it's a mix of sort of one growth phase, investment phase business, and two businesses that are firing really well from an EBITDA perspective. So as that mix changes, you can expect the gross margin and the EBITDA margin profile to change.
All right. And final question before we let you go on House of Brands itself. You've guided for a 30% CAGR over the next few years, a target of 6,000 crore. You've already reached an ARR of 2,700 crores this year with a 70% uptick that we've seen in the first quarter. And we haven't even seen the fashion and the festive season yet for House of Brands. So what kind of growth uptick can we expect in House of Brands for this year and the year thereafter?
So thanks for talking about that. I think, for us, this is one really important strategy that we're watching play out, which is this foray into being a brands business in addition to the retailer business that we've built over the last couple of years. And I think it's astounding the growth that this business has had. It's grown 7x in the last 5 years. It is now a 2,700 crore run rate business on the back of about 10 brands, of which 3 are really sizable, whether that's Dot & Key at about 1,500 crores, Nykaa Cosmetics at 350 crores, and K-Beauty at 250. So I'm feeling really good about some of those big brands that we've got in the mix. These top brands are growing incredibly well. Dot & Key is growing at 100% year on year. K-Beauty is growing at 60% year on year. So this overall beauty side of this House of Brands business, or our beauty brands, are growing at 70% year on year. So I do see a lot of that growth momentum continuing. Obviously it's not going to be at that 70% forever, but I think it's really just the start. We've just started focusing on this side of the business. So there's definitely a lot of growth potential possible here. And for me personally, what I aspire to in this House of Brands business is a very strong EBITDA margin profile. I'm inspired by a lot of the large beauty brand businesses out there, which all trend towards a 20% EBITDA margin profile. So we're trying to build these brands with that kind of discipline in mind.
Where would those margins be right now?
So again, we've not really released that yet. I would say some of the mature brands like Dot & Key are at the mid teens, and some of our newer brands, that we're still investing in are below that. But like I said, the vision over the next 5 years is to get to a 6,000 crore top line for the House of Brands business, and to strive towards, best in class EBITDA profiles, which tend to tend to be around 20%. So, I'm not sure if we'll get to exactly 20% in 5 years, but that is where and how all the brands are being built with that goal in mind.
Okay, so that's the management of Nykaa talking to Mangalam on the Q1 numbers. They do expect growth rate in the fashion business to increase going forward. That stock doing well today, up around 7% at this point in time. In fact, a lot of earning reactions which have been positive. The other one which stands out is Apollo Hospitals, which is up around 6.5%, top gain on the Nifty. Well, we'll take a short break. We'll connect with the management of Nazara Technologies on their Q1 numbers once we're back. Stay tuned.